The balance sheet is one of the essential documents in accounting. But what is its purpose and how can it be easily understood? The balance sheet is a snapshot of a company's financial situation at a given moment. It is divided into two main parts: assets, representing what the company owns, and liabilities, which correspond to what it owes. The assets group together the economic resources of the company. It is structured in three columns: the gross, which represents the initial value of the assets, for example, the purchase cost of a machine. Then there are the depreciations and provisions. This column indicates the loss of value of assets over time. Depreciation applies to tangible and intangible fixed assets, while provisions cover risks related to certain receivables. The third column, the net, corresponds to the residual value of the assets, that is their value, after deducting depreciation or provisions. The assets are divided into two main categories. First of all, fixed assets. They are intended to remain in the company long-term and are held by it to operate the business and create value over the long term exceeding 12 months. These are tangible assets, like physical goods, such as buildings, equipment, or vehicles. Intangible assets, like non-material assets, such as patents, trademarks, or software, and financial assets. The second part consists of current assets, which are more easily convertible into cash, such as inventories, receivables, customers, or even cash. The liabilities, on the other hand, represent the company's sources of financing. We have the equity, composed of shareholder contributions and reinvested profits. Then we have provisions for risks and expenses, the probable liabilities, whose amount and maturity are not precisely fixed. Then we have debts that include contracted loans, bills to be paid, or tax obligations. The balance sheet is an essential tool for assessing the financial situation of the company. It provides an overview of the resources and commitments, thus allowing the measurement of financial health. The analysis of the balance sheet can be enriched by other financial statements, like the income statement, and also by the use of financial ratios. These indicators, such as the debt ratio, repayment capacity, or working capital requirement, allow for a more precise analysis and better understanding of the company's performance and risks.